Hello everybody, it's time to talk about inventory, and before we jump into the different ways of actually valuing inventory, we need to talk about the ways to record inventory. There are two ways. There's the periodic method and there's the perpetual method. The periodic method is essentially when you have your inventory account, and I'll draw the T account here, and you have your cost of goods sold account. And I'll draw that over here. Let's say in your inventory you have $5,000. Using the periodic method of recording inventory, you don't keep track of it every time somebody walks out with some widget. You essentially say, all right, it's now time to do the financial statements. Before we do that, let's conduct an inventory of our inventory. Let's see what we have. So you go, you count everything, and you say, oh look, I have $2,000 of inventory left. Well, you are now at the end of the period, and you just back calculate how much did you actually sell. You would be able to easily figure out that you sold $3,000 worth of your inventory, and that $3,000 goes straight to expense in cost of goods sold. So what leaves inventory is considered sold. It could have been stolen, it could have been whatever, but it doesn't matter. It is expensed as cost of goods sold that way. So that's the periodic method. Under the perpetual method, every sale is recorded as it happens. So in the same situation, you have 5,000 there, but then let's say you sell $1,000 worth of it. It is recorded immediately and goes to cost of goods sold immediately, right there. And then you may sell another 2,000, that's our 3,000 there. It will immediately go there. You keep a running total, so at the end you just sum up your debits and credits and see that you have, in this case, the same $2,000 left in your inventory. So perpetual, you know the beginning balance in both periodic and perpetual, but the unknown in periodic is what went to cost of goods sold. This amount right there. The unknown in perpetual is the ending balance. So you can see there is a difference in how this is done. Okay. Now there's something else that I'd like to cover before we actually get into the meat of inventory evaluation on the next video. Any T account, any account in accounting at all can be designated by base. What that means is that the B stands for beginning, in our case, inventory, because we're talking about the inventory account. The A stands for add. There are things that you add to inventory. The S stands for subtract, things that you subtract. And the bottom is total. It is your ending, in our case, inventory. Well, what gets added to inventory to make our inventory increase? Will it be new purchases of inventory? So we would add purchases. What leaves inventory? Well, as we just showed you, it's cost of goods sold. So let's say that we have an inventory account here, and they give you three figures. They tell you that you had a beginning inventory of $50,000, and you purchased $10,000 worth of new inventory during the time. You would know that that gets added to the inventory account. So that's a debit. You'd put that right there. And then they tell you that your ending inventory was $20,000. Could you calculate what went to cost of goods sold? Certainly. They gave you three of the four things. This, and this. Whenever they give you three, you can always calculate the fourth. Pictorially, it looks like the T account on the right. So we have $60,000 on the left, minus X equals 20,000. I think we can easily figure out that 40,000 went to cost of goods sold. So that's the base formula. You will run into problems where they give you 3 of the 4 numbers, plug them into this, that you begin with something, you add something to it, you subtract something to it, and you'll get an ending inventory. And regardless which 3 numbers they give you, you can solve for the 4th. Okay, in our next inventory recording, we're going to be talking about the methods of actually valuing our inventory. See you then.